In today's lecture, we'll be looking at analysis and interpretation of financial statements. And in this lecture, we are reminded that a good understanding of financial statements and the layouts of such statements is important to be able to analyze and interpret financial statements accurately. What are the issues that we need to know in this topic we are facing today? Today, we will be looking at why we need to do financial ratio analysis. The whole essence of financial analysis is to be able to understand the information in the financial statements reported by various business entities. So sometimes these business entities report financial statements over a period of time. Sometimes the information in the financial statements is to be compared between two business entities. Sometimes it is even to be compared between the industry average and the reporting entity. But then there is no single definition of what financial statement analysis is. But we can just say in a nutshell that financial statement analysis means that we understand the risk and uncertainty of a firm by analyzing the financial information reported by that firm using different accounting techniques. So, what are some of these accounting ratios that we need to know? First and foremost, these financial ratios or accounting ratios are a whole lot, but then we can easily describe the ratios. So let's quickly go ahead to describe these ratios. We have the financial performance or profitability ratios, and under the profitability ratios, we have ratios like return on capital employed, gross profit margin, net profit margin. We also have the working capital or turnover or efficiency ratios. We have, for instance, uh, receivables payment period, payables payment period, and so on and so forth. We have how we have to estimate how well we are able to use the assets to generate revenue, and so on and so forth. We also have liquidity ratios. When we talk about liquidity ratios, we talk about those ratios that show how well a reporting entity can repay its current liabilities. Remember, current liabilities are those amounts that fall due within a period of 1 year. Then we have gearing ratios. When we talk about gearing ratios, we talk about debt ratios. So when we say gearing ratios, we are interested in knowing how well a company is indebted, or how the extent to which, I beg your pardon, a company is indebted, and how that will affect certain indices like total assets and other indices that will make the entity at risk. When we say at risk because we know that in the order of settlement of debt, the amounts that have been given to us by creditors who are secured will surely be paid first before any amount is paid to shareholders. So debt holders usually have priority in settlement of debt, and that is why when a person is no more, the debts that that person has incurred will have to be settled first. That is, if those debts were secured against any assets, will have to be recovered first before any amounts will be paid to shareholders, as the case may be. Now, we have to also look at investor ratios. When we talk about investor ratios, we talk about ratios like the earnings per share, we talk about ratios like the market based indices, we talk about the dividend cover, and so on and so forth. Now, who are the users of financial statements, and what do they need? What is the kind of information that these users need? When we talk about the users of financial statements, we say that These are persons and institutions who require the information in the financial statements prepared by a reporting entity for various reasons. These users depend on the information to make decisions about whether to invest, how to invest, whether to negotiate a new minimum wage, whether to increase tax liability, whether to make more demand from the reporting entity as the case may be with respect to community welfare and so on and so forth. So when we say that these are users of financial statements, what kind of financial statements are these users interested in? Because these financial statements will help us understand what we need to analyze in those financial statements. First and foremost, users are interested in the statement of financial position. Users are also interested in the statement of profit or loss and other comprehensive income. These two financial statements will, among others, will guide us greatly when we are looking at or examining the issue of financial statement analysis. Let me now talk about how to make comparisons, because sometimes the exam question will not always come in one specific pattern. So, what are the patterns that the exam question will come in? First and foremost, the financial ratios will mean that we have to compare the financial statements of a reporting entity over a period of time. And what this implies is that we are going to be comparing the financial statements of the reporting entity, let's say for 2020 and 2021, or for 2021 and 2022 financial year. So sometimes it happens like this, and when it happens this way, then the students will have to follow or obey what the examiner has said. Then, on the other hand, it could be that the student has to compare the accounting ratios obtained from analyzing the financial statements of a reporting entity with the accounting ratios of financial ratios of similar companies in the same sector for the same period. So when this happens, we call this a kind of cross-country analysis. In the third scenario, it is possible that the examiner will want students to compare the accounting of financial statement ratios of a reporting entity with the industry average ratios. The industry average ratios are those ratios that are based on specific industry indices. So the industry indices for a particular industry is obtained, and those indices are used to measure exactly what the focal reporting entity has in its own performance metrics. So for instance, if a reporting entity's gross profit margin is 20% and the industry average is 25%, we say that the reporting entity who has 20% gross profit margin has not done well in relation to the industry average, because on the average in the industry the gross profit margin is 25%. So these and many more are practical aspects of analysis and interpretation of financial statements. Let's now go to the core issues. For examiners will rarely ask you to prepare or to calculate financial statements ratios just for the fun of it. Most of the time, exam questions are set in a manner that would test students' understanding of these ratios, as well as will require students to interpret the ratio. So, on one hand, there is the calculation of the ratio, and on the other hand, there is the interpretation of the ratio. Let me also buttress that most times the examiner would rarely ask students to merely interpret the ratio. Sometimes the examiner may want you to interpret those ratios in the light using a format, maybe in a report form or in a memo, to advise maybe management or shareholders. So whatever the examiner is asking the students to do, it is important that the student adhere strictly to the examiner's instruction, because at the end of the day, it is fulfilling the examiner's instruction that will make sense at some point. So it is not just about calculating these ratios, but more importantly, it is about being able to interpret the ratios and doing the interpretation in an almost accurate manner. So let's now quickly go through with what the examiner may be giving us in the exams. First and foremost, let's look at profitability ratios. When we talk about profitability ratios, we are reminded that every business exists to maximize profit. Yes, I know students sometimes say that businesses exist to make profit, but in reality, businesses do not exist to make profit. Businesses exist to maximize profits. And if businesses exist to maximize profits, then it is important that we are interested in the profitability ratios. So, what are some of the examples of these profitability ratios? Sometimes also, let me stress that the examiner will not give us the exact type of ratio to calculate. So sometimes we have to just use our initiative to know the kind of profitability ratio that we want to prepare or we want to calculate. So let's take for instance that the profitability ratio that I want to calculate today is return on capital employed. Return on capital employed seems to be one of the most overrated accounting ratios, because return on capital employed is simply profit before interest and taxation divided by share capital and reserves plus long-term debt capital plus preference share capital, all multiplied by 100%. Let me take that again. Return on capital employed is profit before interest and tax, all divided by share capital and reserves plus long-term debt capital plus preference share capital, all multiplied by 100%. So what that means is that we are interested in all the capital employed. And remember that capital employed by a reporting entity is the share capital plus reserves plus long-term debt capital such as bank loans, bonds, and loan stock. Where possible, a reporting entity must use the average capital employed during the year. And the average capital employed during the year is the capital employed at the beginning of the year plus the capital employed at the end of the year. When we add these two figures divided by 2, we are going to be having the average capital employed during the year. So, having said this, let us also note that return on capital employed is a profitability ratio, and we are going to be seeing how to calculate return on capital employed very shortly. Let's now move to the next one, which is return on shareholder capital. What do we mean by shareholder capital? I remember in the previous format of the balance sheet, when before the compulsory adoption of the International Financial Reporting Standards, we're told that there is a particular calculation that will give us a summation called shareholders fund. So when we say shareholders fund, we are actually talking about shareholders capital. And what do we really mean by shareholders capital? Shareholders capital is simply share capital and reserves. When we say reserves, we are interested in those reserves out of profit. So, out of the profit, some amounts were kept aside as reserves. These are the amounts that we are interested in. So, what do we mean by return on shareholder capital? Return on shareholder capital is simply profit after tax and preference dividend, all divided by share capital and reserves. So, we multiplied the entire answer by 100%. Remember that anytime you see a formula called return in the in the question or in a question, that means that your answer must be expressed in percentage. So you must always express your answer in percentage. Otherwise, if the examiner is asking you to calculate return on something and you do not express your answer in percentage,